Welcome to the Dividend Talk podcast, episode 134. More earnings fun. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you this week, buddy?
Really great. You know, this was an awesome week with lots of earnings. So, I mean, I'm fully excited for this show, I must say. And yeah, for the rest, really busy at work. I mean, my focus should be always first work than anything else, of course, because that's really what's paying my income so I can invest. So that's how life goes. But other than that, I used every little minute in my spare time to, keep an eye on the earnings popping up because it's been a crazy week.
It's been so jam-packed, both like work, but news of the week, earnings, everything. It's just lots of things have been happening, lots of dividend hikes. I mean, we've a jam-packed show today. I mean, I don't know how we're going to get through this in a timely manner, but we'll give it a good shot. But there's just so much to talk about here.
In the summer, we could have made 4 or 5 shows out of this during cucumber time.
Yeah. But hey, we'll do our best. We'll squeeze it into one as concise as we can. On that note, let's move on to the news of the week because we've got quite a few things. And the first one, I suppose, has been highlighted to us by the community, which I'm not surprised. We talk about Unilever quite a lot on the show, and they've now officially appointed a brand new CEO.
Yeah, and his name is Schumacher, Hein Schumacher. So I like his last name. It's of course a name that many people know from Formula One. So if he's just as quick as good old Michael, then we should be in a lot of fun. And I believe he comes from how is it called, one of the biggest dairy producers in the world, Friesland Campina. What I don't like in him is that he's a former CFO, but he seems to be a golden boy there. So let's hope that he also proves it here. But I generally don't like it when CFOs are in a CEO role, because then they start looking at profitability and such. But I usually miss a little bit this affinity to really understanding the operations of the business and such. So, I mean, I hope to be proven wrong. Let's see. Let's give him the benefit of the doubt. But we saw also with Intel, right, what happens if you have first a CFO like Bob Swan, and then there comes, that looks nice in the beginning with the cash flows, but in the end, if they then underinvest, you screw yourself a few years down the line. So that's a little bit always my worry with CFOs becoming a CEO.
Yeah, I mean, look, he has his roots in Unilever. I think he started off his career there, so he obviously knows the business. And if you go on to the press release, they do a nice little synopsis and biography of him, and they're quick. I think they pointed out in 2 or 3 different parts that he has been part of companies during transition stages. I think Heinz or something was another one. So he's been working in
Heinz got the dividends, right?
Was that under his leadership?
Doesn't matter. It was a company in transition, and they just milked it out. Milked. They just milked it out, and together I think was 3G Capital with Uncle Warren. Yeah. So,
but it looks like he was picked for that reason. They know they're in transition and are trying to turn around. How we stand from a dividend point of view, obviously we don't know. Yeah. Hopefully he doesn't follow sit with Heinz, but it's an interesting appointment. I don't know enough about him, I have to say. So you just have to give him the benefit of the doubt and see where he goes. I mean, 12 months. He's going to start in July, so it's probably not going to be into July the following year till we start to see what he's bringing to the table.
Well, let's say like that. almost anything better than Alan Yopi. He was so bad. He was so bad. So from that point of view, it's good. I also like that it's Nelson Peltz, I believe, is in the board there. So he did a really great job at Procter and Gamble. So yes, I'm also giving it the benefit of the doubt. It's just like I don't like it so much that the CFO is running the show, a former CFO.
Yeah, and it also shows how quick the board want to get Alan Yopi out of there. I don't think usually they stay on board, don't they, for a lot longer than what he is.
Yeah, this was just a month, so I made already a joke like probably Alan Yopi will now go to human resource management, says, "Hey, I still have 3 weeks outstanding. Can I take those as vacations?" And then you have only like 1 week of handover.
Yeah, out the door.
Yeah,
very good. Philips, another European company, is paying dividends, which a lot of people were wondering if they're going to cut the dividend. They did not cut the dividend. They're maintaining the dividend, but there is a caveat with that. They are not paying it in cash. They are paying it in shares. What's your thoughts?
Well, it's it's a dividend out of pocket, out of your own pocket, and we have seen this in Shell actually for quite some time. In 2016, when the oil crisis happened, they started to also dilute shareholders to be able to continue paying the dividend. I guess under stress you can do this maybe as a one-off, but it's not a good sign that they are doing this. It's really not a good sign. Their earnings are also just horrible. So, I mean, I went out of it. People might be now thinking like, oh, it's still good yield, but I mean, again, here also an internal golden boy. Let's see what this person ends up with. The share price was like in the 40s, like before all this mess started, and now it's like 15 or 16. So, you don't need to be a hero. You can also buy the 25 once you see that Philips is on the way back. The settlement is behind them, and you would still get a good yield as a reward. So,
yeah, I mean, there's two ways of looking at this, isn't there? One, I think everybody expected the dividend to be hit. They were keen to preserve it, so they did not want to cut it. So they said they pay it out in shares. So it shows they are trying to look after their shareholders, but we do know we got some problems. And look, some people like to reinvest their dividends. So those that do, it's done automatically without any tax burden here. So look, there's pros to it. As you said, it's not a good sign. It does show that they're under stress and under pressure. But let's see. They seem to be confident they can come out of this, but they have to get through this litigation. And I suppose we've talked about that a lot with 3M, Bayer. It's a long road. It's a long road for them.
But you're diluting your shareholder base now with almost 5%, right? I don't know if the full amount will be in shares and such, but that's a lot of shareholder dilution.
Yeah, a hell of a lot. None of us have shares in Philips anyway, so it's no effect to us.
No.
Another interesting one, talking about litigation. We were quick to praise Johnson & Johnson last week, and maybe we are a little bit too quick, because it seems that their bankruptcy petition has been dismissed in the US.
Yeah, so we were all the time saying like Bayer, 3M, they should go on an internship there with the G&G lawyers.
Yeah.
But no, we've been a bit over optimistic there, I think. But there's now an interesting question. You were doubting about 3M as a holding because of the litigation. How do you think about Johnson & Johnson now?
So I think the key difference for me here is the cost, the estimated cost of litigation. So I've been so busy this week, I haven't really dug into the numbers, but from what I've been reading on Seeking Alpha and other things, I seem to be getting mixed between about 5 billion and 10 billion is going to be the estimated total cost. I mean, these guys generate free cash flow of about 20 billion. So it's less than half that. And their dividends is what, 11, 12 billion.
So they can pay it out of pocket if they want to.
They could pay it out of pocket, but it's going to be spread over 2 or 3 years. So I don't really see an impact to either dividend or even dividend growth. I still actually
or even the balance sheet.
Yeah, I still think that they can cover. So I think that's the key difference. I have to be sure that that's the amount. I don't know. I'm not 100% sure, but from what I'm reading, that seems to be the estimated figure. And once they can comfortably cover that, I'm happy to stay with Johnson & Johnson.
Okay, cool. Hey, and Intel reported earnings like last Thursday, right? And we were a bit earlier with our show then. What do you think about Intel's dividend?
I just cannot see them keeping that dividend this year. I think it's going to be cut. I really
Yeah,
think it's
me
going to be
too.
cut.
Me too.
Expecting to be cut. It's interesting to watch the share price. So we were obviously, we jumped from the show onto
Yeah.
our chat with Dividend Day, and it dropped 9%, which I predicted.
Yeah.
And but it's rebounded. It's rebounded the full 9%, which is crazy. But I think that's based on overall market, and was it Amazon or somebody else posted positive results as well. So it's always interesting around earnings, isn't it?
Yeah. So I also think that the dividend is cut, and we said it often on the show that for us it's a turnaround play, and we're waiting till 2025, right? But Pat Gelsinger didn't look good with this report because they just did kind of a downgrade in their own guidance, I think in November last year, and now again. So I mean, engineering, he seems to be doing the right stuff, but they need to get their financial act together. And Sven Carlin made a video where he even called it fraud that the company is now increasing the depreciation period or the lifespan of the machines from 5 to 8 years. So therefore they get like a 4 billion earnings windfall. Now, guys, we always preach free cash flow here for a reason. Yeah, cash is king. You see in the cash flow statement, much more leaner what it truly is earning in cash, and you kind of with that ignore all the accounting tricks that they are trying to do, like companies like IBM as well, right? So guys, always look at the free cash flow statement. Don't just look at the earnings, the EPS number.
Yeah, it doesn't look too good. I think a lot of the bull case around Intel seems to be around the CHIPS Act and all this America trying to protect that industry because it's going to be overtaken by China. I think that's the biggest bull case for them at the moment.
Yeah, but also some of the new chips coming into the market, and then the deal with ASML. So I'm actually quite bullish on their long-term future, because they're now in survival mode, and they are not anymore complacent like they were like under Bob Swan, right?
Yeah.
So I really feel like and technology, it takes a lot of capex, but also technology develops quick. So if they really get these ASML machines and they can put proper design on the chips there, they will probably straight away have leading edge here compared to their competitors, right? So that's where my bullishness comes from. But again, it's for me this 10% of where I've got also other stocks like Google, Meta, and Baba.
If I wasn't invested, I have a small position in them again. If I wasn't invested, I probably would sit on the sidelines for at least 12 months. I don't.
Exactly.
I don't see the rush. I mean, I'm not buying these guys again unless they drop under $20, because the risk to reward then is greater for me. But if I wasn't invested, I would wait a little bit longer, because I think this turnaround play might be longer than what we anticipate.
Yeah, that's what I think as well. And I would also wait a little bit for the dividend cut, but I think it would even have a positive response to it. I have my thoughts about buying again around $25. So I've got now 1.2% of my portfolio in Intel. I can have like up to 2% in there. My average cost base is probably in the high 30s.
Yeah.
So I feel like I actually haven't really average down yet on my initial costs. So that's where I'm still thinking that at $25 I will nibble in a bit again.
Yeah, cool. And speaking of, we're talking about litigation, we're talking about Intel, we're talking Johnson & Johnson. Interestingly, 3M usually announce the dividend in the first week of February. We haven't heard that yet. What's your thoughts? Are they going to, because it's been marginal raises, hasn't it, the last 2 years?
I think a 1 cent increase, maybe a 0.5 cent increase, maybe even a 0.25 increase per quarter, and then 1 cent overall. But I think they will try to keep the streak, but that's it. Because also, look, I mentioned that also in my video about Intel, and I see 3M the same. And it was also, and I learned this with General Electric. So why these companies are so committed to the dividend? Because we don't have this culture in Europe, right? we if we are lucky, we can buy some shares in our company, but but if you look at America, stock compensation is often a large part of compensation. And you need to know that the generations before us, they were working for 40 years in 3M. Imagine how many shares you would have accumulated.
Yeah.
So if you're then in retirement and you get your like little retirement income, but the dividends of all those, I don't know, few $100,000 of shares you still have, you become dependent on 3M. If 3M will cut the dividend, if Intel will cut the dividend, they will put a lot of their old employees, retirees, potentially into financial distress, because I don't have a lot of illusion that those retirees are thinking about diversifying and such, because their life was around 3M. And that's why I think that those CEOs find it so difficult to cut the dividend in America as well, because these are former colleagues that they are talking about, right? So this is really, and probably a whole town, communities.
Yeah.
So this is why I think they will not do it and try to do a token increase as long as the litigation is still up in the air.
Yeah. I think a dividend cut from 3M would impact their share price a lot more than a dividend cut from Intel.
Yeah, definitely.
I think so, because they are dividend king in 64 years, and a lot of people would wrongfully, but maybe just invest in these types of companies because they're dividend king. So I think that would have a big impact. But we'll see next week. Next week they should release whether they're cutting, keeping the same, or increasing. But I'm interested to watch. Earnings, baby. We have a lot of earnings to get through, and there's a lot that we can't get through. So we'll do our best. But I think we have to start with SHEL. I don't think that's any surprise. I think we have to start there.
Yeah, I mean, big oil, baby. Oil. Now, I mean, we have been in the start of the podcast series, right? We were talking about SHEL, that we were buying shares at that time and such. Let's start with what's the most important: a 15% dividend hike. They're hiking the dividends from 25 cents per quarter to 28.75 cents per quarter. 15%. I mean, this is giving me a really nice bump also in my projected annual dividend income, because it was my biggest position. So at least in my upcoming annual report, I hope that I can say that I'm going to beat the 6% average increase on the year. I will be so happy with this if I at least once reach my own plan. But come on, you know, they had 15.5 billion in free cash flow. I think this was probably the biggest free cash flow per quarter they ever had, 15.5 billion. I mean, this was a stellar year. And I think over the whole year, they had 46 billion in free cash flow. 46 billion. These are Apple numbers that we're used to. I mean, crazy. They are nicely on their CapEx plan with 25 billion. So that's going well. What I also like is that their gearing, and I believe they had always this goal to have the gearing around, I don't know, 25% or something like that, 24%. It was 23% at the end of 2021, and it's now 18.9%, 19%. So they're aiming also for a AA credit rating, from what I've been reading. Not sure if they have it already like that. I forgot about that. But I mean, this is becoming such a rock solid balance sheet there. They have now an earnings per share of 5.43. I mean, if you look at it, listeners, you will probably think like, oh, a 5 PE. Don't step into this trap, because you know the PEs are really low at peak earnings for these companies. So watch out with that one. What I generally also like is that the fact that they bought British BP in 2016 at the first oil crisis was really a golden opportunity. They have paid it already back effectively in cash flow several times, because I think they bought it for 60 billion, but now they have a cash flow just in one quarter of 6.4 billion, and the quarter before 6.7 billion. I mean, just 13 billion in half a year, right? In cash flow from integrated gas. Upstream is 7.2, so it's almost the same. And then, of course, some of the other units are starting to make money as well. What I like actually also is that their capex, their investments, are now really split: 1/3 in growth, 1/3 in transition, and 1/3 in upstream. So when we talk about growth, this is like what they are doing: utilities, wind parks, all these kinds of things. Even I think they're building these electric charging stations and such, and rolling them out. I think they bought also some of those small companies. I really like that, right? And then because we're talking about capital allocation, and the other capital allocation between besides investments and dividends is buybacks. They reduced their share count from 7.6 billion outstanding shares to 7 billion. So that's a reduction of 8.5%. So they have a dividend policy of at least 4% annual dividend growth. Now put 8.5% on top of that by the share reduction, and you're talking already about 12.5%. So what they're really giving us is a 6.5%, 7% dividend growth. But just you see here now the power of share buybacks, and fully out of their cash flow, because they have been reducing their debt at the same time. So this is why we have a 15% dividend hike. It's really this, it's the buybacks. Yeah, and you can see it in the cash flow statement also over time that, let's say in the last quarter, they paid 1.8 billion in dividends, and then 1.7 and a bit in dividends. So that's how you see that, right? So for me, this is excellent capital allocation, and it's a pity that Ben van Beurden left, but I'm glad that the new CEO got the opportunity to give us this great news of the dividend hike.
I was just going to say, you took the words right out of my mouth. I was going to say, what a start from the new CEO. I mean, he could not dream of a better start. These numbers, you quite rightly said, it's like looking at a big tech stock here. It's incredible. The return to shareholders, the reduction in debt. I remember not so long ago they were at 70 billion, and they're down around 44 billion now. So I don't think they're AA yet, but I would not be surprised to see them reach that status this year or the following year. Now, I don't know what the criteria is, but they're well on course. But it's a super start, and 15% hike is just the icing on the cake there. So what a start! But you gotta remember, guys, that it's not always like this with SHEL. It's going to be cyclical. It'll be up and down. You have to enjoy when it's up, and that's simply all we're doing. But it won't stay like this quarter after quarter after quarter. Who knows what will happen by the end of the year?
But the dividend safety.
Oh,
because this was not the case after the oil crisis 2016 up till 2020. It was borderline safe all the time. Yeah. So they took it on the chin, and now we have a really strong balance sheet. 7.5 billion, I think, in dividend payments annually. On typical cash flows, they are really in a safe range, also at the bottom of a cycle.
Yeah, that's the one thing I really like. They've really set themselves up. They've used this mini gold rush that we've had, and they've set themselves up for future. So I think it's really good. It's a testament to Ben who's left us, but it's good opportunity, I think, for the new CEO as well, because he really has a lot of cash there. He's got a lot of opportunities now to really put his foot into the company and take it forward.
So which earnings report stood out to you?
So I've looked at a couple. All three I looked at because they're one of the highest positions in my portfolio, mainly because I was trading on options, so I have multiples of hundreds of their shares. So it's always interesting for me to look at these guys. I mean, it's a typical tobacco story, isn't it? Sale volumes are down, yet they've grown their revenues. How did they do that? Quite simply by increasing prices. It's just their business model. It's built into them. Their sales volume was actually down 12%, and they've grown their revenue by 2%. So they must have increased their prices in around the 14% market. What's interesting is that their earnings per share was up 5%. Half of that is basically due to share buybacks. So we know they've been aggressive in their share buybacks. That's going to start to taper down next year. So you can see the returns coming from those share buybacks. Another interesting fact for me is also that the vapor, another e-vapor that they have, that's also declining. That sales is declining as well. So a lot of their growth is going to come from price increases and buying back shares. They are talking about, they didn't announce it yet, but there is talks that they're going to sell their stake in ticker symbol BUD, Budweiser. They think they have about 11 billion there. So once they sell that, that'll add to their cash flow, which improves their dividend safety as well. And they're also due another billion or two from, I think it's Philip Morris as well, for their stake in, is it Jewel or something? I can't remember off the top of my head. I think it's Jewel, yeah. So they have plenty of cash coming in. Their dividend is safe. I mean, they pay their policies to pay out 80% in dividends, and that still leaves them with about 1.5 billion, which they use to either pay down some debt, which they've been doing aggressively as well, and share buyback. So for me, this is, as I said, it's like a bond. Share price is not going to go anywhere. You've got a really high dividend yield of 8%. You're going to have virtually no growth, but pricing power comes into play here. And I think for the next 2 to 3 years, I think they're okay to have, but I think Philip Morris will then start breaking into the US market a bit more, don't they? I think they have some agreement from 2024 that they can move some of the non-tobacco markets there. So we might start to see Philip Morris then a little bit more competitive over there.
Yeah, and I think they wanted to remerge not too long ago, but I think it was rejected. What my issue is with when I hear you talking is it feels like they are trying to sell the last crown jewels they have. Yeah, from the old family, maybe. That's how it feels. So I hope they spend this money wisely, because otherwise, what's there for the company?
Yeah, I mean, look,
is there any growth catalyst that you see? Is there any catalyst?
I don't. The only catalyst in growth is share buybacks. That's the only thing you can see in with them. I mean, they haven't made good decisions buying Jewel, Kronos. I mean, they've made some historically bad decisions there. So it's hard for me to see any sort of growth here. It's really just a high yield play, the hold for maybe 2 years, and then when Philip Morris comes back into the US market, it's probably a good time to sell. But I didn't see anything in this report. I didn't think it was disappointing, because they can increase their prices, but I just don't see a growth catalyst here for these.
Yeah. Well, then I will also do my confession of a high yield alcoholic, let's say, because I've got Omega Healthcare in my portfolio as a yield play, not as a growth play, but just for high income. I think if I go to my portfolio, I would see that it probably paid like 25 to 40% already back in dividends of my entire investment. So that was also my thesis. But the results were ugly. It was as expected that they were ugly. So if you think about funds from operations, they actually had a 13 cents negative per share. If you look at adjusted funds from operations, they had 73% common share, which is more than the 67%, 67 cents in dividends that they are paying already for many, many quarters. Yeah. What I really like with this company is Taylor Pickett, the CEO. He is just a straight shooter. So he mentions here, as we previously announced, our first quarter earnings will be further impacted by deferred rents associated with additional operators restructurings. Bearing additional unforeseen restructurings, we would expect our operating performance to improve as the year progresses and operating restructures are completed. However, with both facility occupancy and profitability still meaningful below the pre-pandemic levels, the risk of further operating issues remains. And this is what I so much like about the CEO. Just says what it is about, doesn't, sugarcoat everything, committed to the dividend. But then, for instance, during the fourth quarter, again, Agemo, one of their operators, they continue to not pay its contractual rent and interest due under its lease and loan agreements. Then Healthcare Homes, a UK-based operator, 2.5% of their rent income, are also deferring their rent. They ask, let's say, postponement for paying it till April. So they are the nice thing is in these contracts is that, how to say it in simple language, I guess Omega Healthcare gets the authority then to restructure those, and for instance, if they go bankrupt or whatever, to sell the assets and or to do something else with it, right? So they're really, at the moment, they're just like kind of a debt collector, in my opinion, that's trying to still get the assets and sell them, and trying to do this for a positive return or find someone else to get in there, and that's impacting them. What I do like in general is also what the CEO is saying, that Medicaid, I believe, has been increasing the compensation and so and such, also to the nursing facility operators. So it is going well, but generally the industry is weak, but they still see the long-term growth catalyst of the boomers, right? So for me, this dividend could be cut any moment when you look just at the statistics. But I think the CEO doesn't feel he needs to cut it yet, while they're doing all this restructuring, because there's still light in the end of the tunnel.
Yeah, it's interesting to watch it play out, and like that, it's one of those ones where if you're in it quite some time, which is fine, but if you're going into it now for just the high yield, I think it's a little bit more riskier now than it was 4 years ago.
Yeah, definitely. 4 years ago, these problems were hardly surfacing.
Yeah. Interesting. I'm going to shift gears a little bit and go to a European company again, which is ABB. It's a company I follow. I have a couple of shares in a trading 212 POI that I add to automatically, but it's a company that I really like because I use a lot of their products. But I have to say their full year report wasn't really too great. I know they're coming off a high base. 2021 was really a strong year for them. We had lots of orders. They were struggling for parts, so their order book built up, and there was people scared they weren't going to be able to order more, so they're ordering lots more. So I know they're coming from a high base, but we're starting to see, particularly in the last quarter, that orders are starting to drop significantly, particularly in robotics and automation, which is the one that I'm definitely most interested in. But we can start to see that taper down now to a new base level. In saying that, the revenues are up roughly 2 to 3%. Their free cash flow was down, mainly due to working capital. They've added a little bit to their debt because they've been buying quite some companies, actually, particularly in the electrification segment, which they're really trying to push, and it's doing quite well for them. And they've bought a couple in the motion segment as well. This year, their main focuses are to just improve revenue growth, and they really want to focus on the free cash flow, so they're going to drive down working capital. And again, what I do like is that they're continuing to reward shareholders. So they're proposing to increase the dividend again and to continue their share buybacks for 2023. So I really think we're starting to see a base level for them now. I know 2021 was a high level, so I'm more interested to see where they can grow from 2023 on.
Nice one. It's one of those engineering companies that you like. So
yeah, I use their products, and I really like the company, and I really want to own them. They're still overvalued for my liking. I think this earnings is a little bit disappointing. I haven't checked, but I assume the share price might have dropped a little bit based on orders dropping. I think it was like 12% last quarter, so I'm assuming there might be a drop, but I need these to drop another 10-15% before I'll start adding them to my real portfolio.
Cool. Yeah, so then also for me still quickly, this European company continues to amaze me. If there's one worldwide catalyst, it's like unhealthy living and effectively just people that are oversized. So in this case, Novo Nordisk sales went up by 25%, Derek. 25% year over year. That's like you increase your business by a fourth. Imagine how much growth that is for any company, a fourth, right? And this is not a new company. EPS grew by 18%. They hiked their dividend by 19% to 12.4 Danish crowns. And this is already, I don't know, they've been paying dividends since 1997, continuous growth. I mean, it's really, really amazing. So if you look at it, right, sales in North America increased by 35%. So, I mean, sales with diabetes and obesity care increased 29%. I mean, people start eating more healthier. That's the only thing I can say here when I see the Novo Nordisk results. I'm bloody frustrated because I wanted to buy them around 400 Danish crowns around the COVID period. But that's the issue. It was a candy store at the moment. I looked at other companies. I wasn't so smart yet to focus more on higher quality. Of course, it flew away. It's gone for me. Hopefully it will ever come back. It should be one time. But what a company. What a company. It's probably, after ASML, one of the best companies at the moment in Europe.
Yeah, I mean, it's frightening in a way, though. Obesity care sales grew by 101%. It's frightening, isn't it? What's happening out there? And on one side, you have companies that are pushing health and healthy options, and we use that as a growth catalyst, that people are going to focus on that. And then you look on the other side and you see Novo Nordisk, and then you have to think, is it a growth catalyst? Because are people really following this? Because they're getting sucked in by too many ads, getting sucked in by the candy store, McDonald's, whatever it is. I mean, it's frightening, but serious numbers from Novo Nordisk. And I know we spoke around COVID about buying these. We both didn't. And I think we both sincerely regretted it ever since. I think shortly after COVID, it was probably about 2 months after, and it just flew.
Yeah, you had a really short window of opportunity. It was like really short.
Yeah, so it's a shame, but I mean, I know lots of our community hold this company, and I'm happy for them. But it's
yeah.
I mean,
congratulations with your 19% salary increase.
Yeah, I mean, inflation. Who cares about 7% inflation if you're getting a 19% increase in your wages? So, definitely a powerhouse of Europe, and one of our greatest assets, I would say.
Yeah, and then the last one. I don't know if we can call it an entire European company, but Swiss-based CHUB.
Yeah.
They had a really nice quarter as well, an EPS of $3.13 for the quarter, and for the full year, $12.55. The return on equity for them, that's why you need to look a little bit at this company, was 9.6%, which is pretty good. Yeah, if you get a 10 return on equity. And I believe their combined ratio, it's one of the key metrics for a company like them, is around 85-87%. Effectively, it means like they earn a little bit more in premiums than that they need to pay in claims. So that's what we're talking here about. For me, it was the company I bought with my Disney money when I sold Disney at $100. It's now $209. So it's already two-bagger. Dividend per share currently $3.32. They still need to pay 1 quarter in the same amount, and then I expect a hike. But they have been all the time hiking, quite relatively conservative over the last few years. But what this company does is, like, once in the 5 to 8 years, it suddenly has a big bump. Yeah, so the payout ratio is now 26%. The yield is 1.5%. So I think it's really due for a double-digit hike, maybe around the second quarter somewhere. So that's my hope estimate, or how you say it, hope estimate.
Yeah. Yes. Let's keep an eye and see what the dividend increase. I think actually it's a good point to move on to our segment where we talk about dividend increases, because there's quite a few to go through. I do have a fun fact to share, because I know you just mentioned you hope they have a big increase. In January, there was 45 double-digit dividend hikes in the US. This is the US now, just the US, with 111 increases announced in January. That's incredible. And the average dividend hike was 12.8%, just in the first month of the year.
Yeah. Who says dividend investing is boring and not what was it always like, not gonna make it, I think was what the crypto crowd was telling us.
Yeah,
Yeah.
and I mean, people talk about total return as well. You won't
Yeah,
make total return and all this. I mean, the evidence is out there. It's possible. So
exactly.
it's there. But I just thought that was a fun fact. If that's the start of the year, we're in for a hell of a year, guys.
Yeah. Shall I quickly run through them?
Yeah, there's loads.
Okay. So we know about Philips spin-offs, right? They always
Yes.
do better. So NXP Semiconductors hikes the dividend by 20%, ticker symbol NXPI. If you look for the American symbol, what is cool, in 2019, they paid like 25 cents per quarter. Now they pay $1 per quarter. So 4 times more. You can get it for 1.7 percent yield. It was trading not too long ago for $160. Then you get 2.5% yield. I'm seriously considering doing some analysis on this stock because this is a really, really heavy dividend grower. And if one of the listeners owns NXP and could explain a little bit more why they own it, please put it on the Facebook for us and please put some words. I'm really interested to learn a bit more. ASSA Abloy, our locksmith, that we always make fun of. Company hiked the dividend by 14% to 4.8 Swedish crowns. Novartis hikes the dividend by, unfortunately, only 3.2% to 3.2 Swiss franc, 29th year of a growing dividend. Roche increased the dividend by 9.3 Swiss franc to 9.5 Swiss franc. I believe it's a 36th year of a growing dividend.
Yeah.
KPN, the Dutch one, the Dutch telecom provider, hikes the forecasted dividend by 4.9%. Sanofi hikes the dividend by 6.9%. And honestly, also someone on Twitter mentioned it. That was unexpected. For me, it was also unexpected because the company is not, in my opinion, with their pipeline struggling. Yeah, exactly. Then let's make a small shift to the other side of the pond, to America. Church & Dwight hikes the dividend by 3.8%, ticker symbol CHD. UPS hikes the dividend by 6.6% after last year, I believe, hiking it with 50%. Gilead Sciences hikes the dividend by 2.7%, ticker symbol GILD. CME Group, Moody's, MMSCI all hike their dividends with 10%. Now, then there is also bad news. Electrolux, they propose that they will pay no dividend over 2022. So an entire dividend cut after, I think, 10 or 11 years of decent dividend growth again. So really, really, really disappointing. I don't think many people own it, but still. And GSK, I mean, they didn't mention anything new. They had the spin-off, they reset the dividends, and they kind of keep it as it is. So, which I think is also a bit disappointing for some GSK owners.
Yeah, some really good companies there, some really great dividend hikes. It's interesting to see, well, for me, CME Group, Moody's, and MSCI all in and around the same bracket, all with 10% hikes as well. So, no, interesting. And Europe is keeping up with the US this month, I have to say.
Oh, definitely. They're doing very well.
Okay, we have a portfolio review from William, which was emailed into us, and the email was fairly extensive, I have to say. It's probably one of the best ones we've got in terms of explanation and thoughts in and around the portfolio. Maybe you want to talk through a little bit of how it's structured, and then we'll try and talk a little bit about it.
Yeah, so William, he is a theme-based investor, and that's what I really like. So it's not necessarily my style. I look at more like sectors, kind of, but really high level, the 11 sectors, right? But generally, I just look at individual businesses and whether I like them or not. And then I think about what's the catalyst, right? For instance, aging population and such. But he turned it around. He rather looks, let's say, at first one, for instance, infrastructure, but then based on, for instance, climate change, a shifting globalization framework, sustainability. He looks at those factors, right? Another one is transportation, like how the how the world is and the globalization is shifting, right? And then yes, there are some advanced materials or value-oriented consumables. So it's really interesting to see a theme-based portfolio. But that's also exactly straight away one of my feedbacks. This is not a pure dividend growth portfolio, right? And usually you and I look at an angle from dividend growth. So this makes it for me already harder to really say something meaningful, because I'm not a total return investor. Total return is something what I expect, because I'm a dividend growth investor, and my emphasis is of course on growth. If there's no growth, then why you can't expect a dividend to grow either. Yeah, so that's maybe the main one. But then if I look at it, I think it's a really smart setup portfolio. So if you look at infrastructure, he for instance, ticker symbol ACM, ACOM, is an engineering design firm that works directly on assisting with major building projects. So he's really, really particular. Also, waste management is in here, or Jacobs. Yeah, you might know this firm as well. I know they are big in the oil and gas industry, as well as engineering procurement contractor. I really like this way of thinking here. Have a bit of the industry leaders in there, and it's just not my style of investing. So I find it a bit hard to give a meaningful feedback on here. For instance, if I look at transportation, he has Zim in there. You used it for dividend capture. He knows also that those dividends are at risk for payout. For me, it feels with that there's a lot of also capital risk, risk of capital loss here. But again, it's a bit hard for me because I don't never look with such an angle to such an portfolio.
Yeah, I think it's a really interesting way to structure a portfolio. It's well thought out, and you spoke about growth catalysts. And if you look at each subheading, I would say that he has, like infrastructure, transport. Actually, when you sit back and look at it, they have to grow. They're definitely an inherent growth catalyst within them. I don't know all the companies that he has, particularly around infrastructure, but from the companies that I do know, particularly shipping, advanced materials, and so on, there's some quality names in there. He has Texas Instruments in there. He has Ingredion in there. He has Hershey's, Coca-Cola, Pepsi, Walmart. He's got Realty Income. Blackstone is in there. Apple, Microsoft is in there. So there's some really good companies. He also has Diageo, which I liked. He couldn't find a particular spot for it, so stuck it in under miscellaneous. But I do really think that it is a growth oriented portfolio. I think he's definitely looking at total return. I don't know enough about all the companies to get a good feel of whether dividend growth is going to be high. But he has made some interesting remarks, particularly around fixed income. So in his opinion, fixed income exposure is important to any portfolio, and it shocks him how little exposure so many dividend oriented portfolios have. He has 4 ETFs and 1 BDC. For me personally, and I see that, so some of the ticker symbols he has is Angel, ANGL, Horizon, HRZN. Then he's got ticker symbol JPIB and ticker symbol TLT. And just reading his description of these companies, one of them is venture debt, one of them is international bonds, one of them is treasuries, one of them is investment grade corporate bonds, and then another one is a high yield corporate bond. I think that says enough of why a lot of dividend oriented investors don't get involved in these, because they sound really complex and risky. They might not be. Disclaimer, I don't know enough about these to say if they are or not, but they seem a little bit more complicated than looking at a Johnson & Johnson, Texas Instruments, Blackstone, for example. Fixed income definitely seems maybe riskier, but maybe there's a steeper learning curve with them. What do you think?
Not my circle of competence. That's actually just here. I can also get high yield dividend growth stocks, or I mean, Omega Healthcare is not a growth part of dividend stocks, but yeah, just not my circle of competence. It's for me a bit too difficult to learn as well, to really understand what it is. And I also, ETFs in general, dividend growth from ETFs is really tricky, right? Specifically for Europeans and having access to it, because he has also some of those, I said,
the derivative income ETFs.
Yeah, exactly. I don't have access to it, so I don't even spend time on learning it. Yeah. So that's kind of where I'm at a disadvantage. And I fully understand this point. He's probably right. The BCDs, I hear a lot about that, and it seems to be really attractive. Some really good ones out there. But I have yet to find also passion for it to invest in this. And I think that's also important. So it's not just only like the golden mountain at the end of the rainbow. It is also whether if it excites you even to think about it. So, and I don't have that. So
So I think our key takeaways are structure. It looks absolutely wonderful, well thought out. I think a lot more investors could do it, not following it exactly, but the thinking behind it, I think, is important. Lots of top quality names, but we don't know enough about some of the tickers and some of the instruments in here to give a full honest opinion. But from a dividend growth perspective, the companies we do know are pretty damn solid. So I think it's a good portfolio overall.
Cool. Okay, time then for some of the listeners' questions. And the first one is from Dave Specialista, and he is asking what our thoughts are about Levi Strauss, ticker symbol LEVI. So I looked it up, and it passes my screener criteria. It has a PE of 14 at the moment. It pays 48 cents in dividends annually. Last year it paid, so now 12 cents per quarter. It was 10 cents per quarter before, so it's like a 20% dividend hike. At the moment, it's having a 3.2% dividend yield, according to the Nasdaq website. But the payout ratio is relatively low because the EPS is estimated to be $1.34. So so far it actually passes all the screener criteria. It's of course an iconic brand, Levi's. So yeah, it might be worth a deeper look, I would say. And yeah, so from a screening point of view, it looks okay.
Yeah, from a screening point of view, it looks okay. My body would be similar to VFC at the moment, and apparels they might struggle over the next year or two, particularly in the current market. But brand power certainly have it, and it does pass my initial screener as well. So it looks good. But what I do find is that when we get listener questions, they always seem to pass our screeners, most of them, because a lot of people do their due diligence. It's just some companies are not on our radar, which is why it's always interesting to have these. So thank you for that, Dave. Gordon he said his head is spinning from all the adjusted earnings this week. I think this was actually last week. How do you deal with that? Dismiss them, take them into consideration, case by case.
Most of the time I ignore them. Most of the time I just ignore them, and I do my own calculation, right? I look just at the net income of the income statement, and they need to put the real EPS there. I look what that is. And then if I see a big delta between the adjusted EPS, I usually go to the commentary, because they need to specify where the difference is from, and then you can read it. And if you then look into it's usually a table in every report where they add back earnings in because of one-time events. And then I can judge, is this just a result of management decisions, or is it really like something like the external that they couldn't do anything? But for instance, for me, restructuring, I never like it when they take that out of the EPS, because those businesses that nowadays, they are continuously restructuring. When you're like a company with 100,000 employees, there's always a restructuring going on, always. So for me, it is just part of business and shouldn't be left out of the EPS, as an example. But if you have like really like a one-time tax event or something like that, or a one-time pension liability write-off, or like contribution, I can imagine that you keep it out for comparison. but it's still like a result of, for instance, underfunding the pension liabilities over all those years. So actually bumping up the EPS in the past and then take a one-off. So, you know, in the end, almost everything is management decisions. So I tend to ignore the adjusted earnings.
Keep Walking has asked us, do we have any investment in CEFs, which is closed-end funds? I did until the loophole in IBRK. Remember when everybody was buying all these shares and I said it's not going to happen. So I could buy CEFs for about 2 years, absolutely no problem. This loophole got abused. Not only did that get shut off, but also my ability to buy closed-end funds. So what I've done actually this month is I've sold all of them. If I can't buy any more, there's no point in me holding them. I was only adding a small portion as I was going along. So yeah, not anymore. Not anymore. I'm afraid that's taken away from me.
No. Hey, Centrino is asking, if you want to buy SHEL right now, on which stock exchange would you buy it and which currency?
Oh, I hold them on the Amsterdam Stock Exchange still, but I would probably buy them on the local one, maybe.
Well, I think if you're in a euro-based currency zone, it's maybe good to keep there. You pay 15% dividend withholding, no, 0% dividend withholding tax, so that doesn't really matter, and you don't have currency risk. So, but otherwise, I would, in my case with the zloty, I would now buy in rather in pounds than in euro. But I have already my whole position in euro and I keep it there because I usually like you say, I like to have them at the local exchange where they trade. But of course, SHEL's a little bit blended because it was dual listed for 50 or 60 years, right?
Yeah. So when I bought them, they were on Amsterdam, which is technically their local exchange, which is where I bought them. But if I was buying them now, it would probably be London. Maybe.
Yeah.
Jacob has been investing for over a year and now once again largely green on all his investments due to the recent run. When monthly investing, how do you decide what stocks to buy and dollar cost average in? He's finding it harder to choose buying up the way than it is when the price is falling down.
Yeah, this is psychology that we all go through. We all need to learn it. And this is one of the hardest things to do. You know what's helping me, Jacob? I know what I want to pay for a company. So if you would draw a line, like a line from on a chart from left to right, and it goes steep, let's say it goes up towards the right, just a linear line. If you then start, let's say, putting waves as a pendulum over that, then you know when it's kind of overvalued and when it's kind of undervalued. Based on my valuation, every time when it's undervalued, I find it a reason to buy. So and then dollar cost averaging up becomes less of a problem because you then get in your mind, oh, actually it's overvalued, so I can still buy something. If before I didn't have that, and then you're price anchored on your lowest buy, and then it's really, really, really hard. But I'm sure you buy then another stock where you initiate a position quite easily, although you could see that it was maybe half a year 20% lower, right? So it's really, really mixing up the minds, I would say.
Yeah, it's almost like pretending you don't own that stock already.
Yeah, exactly.
And still see if you want to buy them, and if you do, buy them.
Yeah. So in some cases, what people do is they just automate it. They just have an automatic order. Every week they buy one share. Yeah, some people do that. I think Russ did it. 100 weeks, one share of Pepsi every Monday morning. Then you take the emotions out of it.
Yeah. We have this problem sometimes too. I had it with Microsoft, so it's you're not alone. It's a constant battle, but I think sometimes it's depending on the company. Sometimes it's easier, but I think pretending you don't own the company and still, if you still think it's a fair price, I think that's a good way to approach it. Herman has asked us our thoughts on Lidl Basel, ticker symbol LYB. Are they on your watch list? They are on my watch list, but I have not put the time in to analyze them. So I can't give an honest feedback on them. I do know I had them in my portfolio before because the dividend growth investor invested in him when I was following him in the beginning. I took him out and put them on the list to analyze and go through, and I haven't. What I do know is that they nearly went bankrupt before, or they did go bankrupt, and they did cut their dividend before. So that's probably the main reason why I've not put as much time into them. So I don't know. I know recently over the last 5 or 6 years that dividend growth has been quite good. I just don't understand, not understand, but I don't know enough about the business or growth aspects to give it an honest answer. But they are on my watch list, but probably low down on my watch list, I would say.
Yeah, and they have a PE of 7.5.
Yeah.
And a 5.5% dividend. So I can understand that it pops up on a lot of radars. I need to look into it one more time again.
Cool. Tiago has asked us, Intel earnings were not great, but the stock is trading above what is prior to earnings. Did you bet against Pat?
No, you never bet against Pat.
I mean, if you want to make money, with Intel, okay, all you have to do is sell cover calls before earnings, it'll drop, cash out,
exactly,
and then sell cash secure puts, and it'll go up again. It's after happening. I think last 6 earnings in a row. It's nearly predictable at this stage. It's quite funny, but
yeah.
No, we did not bet against Pat. We did not bet. George has asked us, any thought on the real estate market in Europe, Vonovia and like worth the trouble?
No.
Yeah, the European real estate market is complex and hard, and companies like Vonovia are struggling at the moment. So I do recommend listening to that podcast we had with the CEO of the Farmer as well, Matthias. Yeah. It gives some really, really good insights around European markets. So for me, I don't hold any at the moment in Europe. I think Realty Income is the only one that I have. So
yeah, I've got Cibus, but you need to know I am aware of the risks, and these are really, so I work with this tier 4 system, right? So for me, I don't own Vonovia and I don't need it. I own some Defama, and I own then some Cibus. And Cibus, for me, I know the risk, I see the risk, it's the debt profile. It's such a small position that I sleep well at night. But if you're still, for instance, in your early stage, the first 2 years, personally, I would stay away from it. Too much risks, and we really don't know what's in those balance sheets. We really don't know. For instance, these real estate companies, they depend a lot on the valuation of their assets. As soon as they start to write down, you get really screwed. Yes, so, and it's not a liquid market at times.
Yeah, a lot to think about. Jarson has asked us, what value do you go for ASSA ABLOY?
I don't know yet, just sir, and I really want to run it through. I got this question several times today because I put a tweet out on ASSA ABLOY that I would like to have it sooner than later. I'm thinking even just about buying 1 share if it's needed, just to have it in my portfolio and that I can say that I own it. It looks bloody expensive, really expensive, but I want to run it through my discounted cash flow model, and then once I've done that, I will share it on social media. So maybe later this weekend or maybe next week, and let's see what comes out of it. I'm afraid that it's heavily overvalued.
Normally good companies like that are. Jens Minator has asked us, what is on our watch lists?
Well, I've got a really large watch list. I know which 40 stocks I want to own, of course. But if you think about where I could consider some buying over the last week, where I was looking, of course, Johnson & Johnson popped up on the radar in the low 160, but I like it around 155. I could still buy some more T. Rowe Price as an example. But I'm mostly waiting for the earnings a little bit, because I find it a bit difficult to buy shares in a company now, for instance, 3 days before their earnings. So I want to kind of wait till next week for earnings to come in, and then I will start buying something again and have a better picture on it.
Yeah. Blackstone, T. Rowe Price are are on mine as well. But like you, earnings season still has a little bit to play out, particularly Europeans. I think we might even have till the end of the month. So February is always a tough month to buy.
Yes, and for instance, I would also like to buy some more Ahold again. So maybe when it trades at 25 euro or something like that, I will nibble in a little bit. So yeah.
Cool. Ivan has asked us, would it be possible to discuss what you do with Disney, a very long-term hold as a dividend investor? For me, if you're a dividend investor, you're selling Disney because I don't see that dividend coming back anytime soon. Great company, but I don't see that dividend coming back. So
wonderful business in the business of magic, but a poor stock.
Yeah, only on the basis that you have as a dividend investor.
Yeah, exactly. Yeah, as a dividend investor. And I don't know if because you didn't mention dividend growth investor either.
Yes.
So I was also wondering, is this on purpose or
So if you're holding it, waiting for the dividend to be reinstated, it's a risky play. It could happen. I mean, we don't know. It could happen. I just don't see it.
And it won't be a fat dividend if you think about how Disney was paying. Disney was just paying 2 times a year a dividend. It was atypical for American stocks in how they pay the dividend, and was also not a large dividend. Yeah. So I don't really have a expectation there, and I also don't know how much money burning the streaming war still is. Netflix was doing really well. Personally, I see at home that we don't watch Disney Plus that much. Our children are still gravitating back towards Netflix all the time, so we canceled it, and then there was a new series on, so we turned it on again. And I just see that kind of the stickiness is the most with Netflix for us and HBO Max, and the least with Disney Plus. Although Disney Plus, we have the most memories with all these movies.
Yeah. M. Markovich, he sees a lot of high yield ETFs now. What is our take?
Yeah, I don't buy ETFs, so.
Yeah, I mean, I think we discussed it earlier a little bit. It's hard for us to buy them really good ones in the US. And for me personally, we have this deemed disposal rule, which I've spoke of. It's an Irish specific rule where I have to pretend to sell every 8 years and every subsequent year after that and pay capital gains. So it's a pain tax wise. So ETFs are not on my horizon. Tim has asked us, how do you guys deal with the psychological buzz you get when you buy a new company versus balancing that with the patience you need?
Yeah, I wrote an article about that one time, right? For instance, how to also deal with a falling knife. I try to buy, for instance, not more than once a month. It's also a bit hard with the capital that I have at my disposal. So that helps already. Yeah, and usually I don't feel like buying the same company twice in a row because there's so much out there that I want to buy that I usually also split the money a little bit between different stocks. So naturally it becomes a little bit less of an issue. Last year I bought quite some Castellum, but I also did it like after a while all the time. Yeah, so I don't really have an issue with this anymore, I must say. It's not like when I see stock go down, I think buy, and I throw all my cash at it in a month or something like that, and suddenly it comes from nowhere, being my biggest position.
Yeah,
I don't have this issue.
Marek has asked us, do you like when prices go high? The answer is no.
No.
No,
Marek. Yeah.
I can't pronounce the first name. Twyman Van Dyke, great second name. Like us, he has Alibaba in a portfolio. At what point are you selling it because it does not fit your DJI strategy? I do not hold it anymore.
Yeah, I still hold it, and I had my sell order at $300. So I'm waiting for it to get there. It's now at $100, so I still have a long. So Twyman, when I bought it, I said I give it 3 years to double. I bought it at around $150. I thought it was worth towards $260. So I thought, okay, if it gets a bit overvalued, it will be $300. That was my thesis. We're now 2 years down the road. It's of course turned south. It's part of my 10% non-dividend growth portfolio, actually a little bit for this value investing. So yeah, I'm still waiting a year, and then I'll reassess again.
Yeah, I'm expecting you to say you're holding it and give it another 3 years, and then you're going to hold it for another 3 years, and so on.
Maybe, yeah, maybe. Who knows?
We'll
if there's value, then I see no reason to sell it.
Yeah, exactly. Yeah, you're right. Royco has asked, what YouTube channels and podcasts do you follow and recommend?
I like Sven Carlin a lot. I was for some time with Everything Money, these three guys, but then they fired the guy that I had the most sympathy for, and now these two are for me are like even all the thumbnails. I hate them already with all the time scared faces on everything. So then I just know they're really only trying to manipulate me. So no, it's mainly Sven Carlin. And the podcast, I listen to the Dutch one. It's called Burst Talk. It's released every Friday evening. I like that one as well. I listened already to it for probably 10 years. And then there are some really good podcasts like, what's it called? It's about We Study Billionaires or something like that. I really, really like that one. I think it's from the Investors Podcast or the Investors Network. I really like that one as well, and they have really some hidden gems in those episodes.
Yeah.
And by the way, what about Mike?
Yeah, I was
Mike,
just going to say,
the dividend guy.
I think Mike has a pretty good show. There's a couple in Ireland that I listen to, in around investing. And on YouTube, I just kind of flick around. I don't really follow anyone. I just kind of see what comes up. I did not know that they got rid of the guy on Everything Money. That's interesting. He was the guy that was kind of presenting. He wasn't really.
Yeah, exactly. Yeah. It was them keeping their feet on the ground and asking them the challenging questions. And now these two are as cocky as hell, and they have nobody anymore that kind of challenges them.
Yeah, I mean, I used to watch a couple of their videos, the 5 pillars, if I remember correctly. And it was interesting, but I just found most of the time it was trying to plug their software, and that's what really,
exactly.
That's what really bugged me. The principles behind it was fine. The investing was sound, but it just seemed like they were pushing this all the time, and that's not what I want to watch YouTube for. So
exactly.
Interesting. Okay, that's the end of the show. We managed to cram that in about 1 hour and 12 minutes, which I did not think we would do. And we missed a lot of companies like Starbucks. I know we didn't talk about Starbucks, for example. You would have probably
not about Apple, not about McDonald's, not about ExxonMobil.
So it's been a good weekend. It's a bank holiday weekend over here in Ireland, so I'll get a bit more time, particularly on Monday, to sit down and dive into some reports. So looking forward to it.
Good. Everyone, have a great week ahead, and happy earnings week again, and hopefully many more dividend hikes.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.